Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is time to talk about money. Here we are on KLFE, The Answer. And we have the answer about money, hopefully. Anyway, last week, I started with one of my favorite quotes for this time of year. It's by that great intellectual guru, Yogi Berra. Yogi Berra, as I said last week, I asked Sarah, our administrative assistant, if she knew who it was. She said, "Is he the cartoon character?" I said, "No, he's the catcher. He was a catcher for the New York Yankees." His quote, the quote that I like this time of year, is he said, "Predictions are difficult, especially about the future." That's what we've been talked about some last week. We'll continue that this week. Last week I did a lot of recap on what happened in 2018 because it was a little unusual. We had a very, very good market going in for the first 9 months. That's what I had predicted. We were going to have a very good market in 2018, and then everything came crashing down by the end of the year. Standard & Poor's was negative. We happened to be about 1% by my best estimates. Our numbers are in, but I haven't had a chance to review them. They came in today, so I will know what the numbers are by next week. I think we were up 1% compared to the S&P 500, which was down 6%. So that's, on a relative basis, that's really good. But we were up almost 20% in September. So being 1% was pretty disappointing. Now we're on the other side of the rally. I explained what was going on, how I thought it was computer-driven algorithms. And it's well worth it. If you didn't listen to the program last week, to go ahead and listen to the program. You'll find it on YouTube. You can Google Adams Financial Concepts about money, and you'll find and dial down through the programs until you find last week's. It's listed by the date, and so it's well worth it. I say that because it was me talking. What else can I say? Okay. So before I get to the predictions, I've got a great guest today. You want to hear what he has to say, But before I get to the predictions, I want to talk about the Money Show because it's coming to Seattle. I've been asked to do a workshop, maybe 2 or maybe 3. And so what is it? It's a group of leading economists, renowned market strategists, top-performing portfolio managers, people like Steve Forbes, now on the schedule to come, Ralph Akamora, Bruce Johnston of Fidelity, John Stone of Fidelity, Larry Kudlow, who's now in the White House, Edward Yardeni, who I think is one of the top economists in the country, Louis Navellier, who is one of the best known, and there's a guy by the name of Mike Adams, who you're listening to. So anyway, do come. It's free. You can sign up. It's going to be June 15th and 16th. The registration and walk around is the morning of Saturday the 15th. The program will begin, actually. The workshops begin and the general sessions begin at 12:30. It'll go through the afternoon and all day Sunday the 16th. I think I speak on the 16th. I speak in the afternoon on the 15th around 3:15. There's a break in the day, and I'm on stage in the exhibit hall. We have an exhibit booth. We'll be right by the booth of KLFE. Surprise, KFLE, yes. I get the initials right, I hope. So yes. So they will have a booth right next to the Adams Financial Concepts booth. Come see us, come see KFLE. Come see some of the others that are there as well. I will also be speaking in Orlando. Probably pretty much the same presentation. I'm like a politician, give the same speech over and over again. Or doing a play at the theater. You say, do the same play. Well worth hearing. So you can listen to me in Orlando. You can stream that. It'll be webcast. You can hear that presentation there, and then come to Seattle and see it live. Actually, if you want to go to Orlando and fly to Orlando, you can see me live there. I've been going to the Money Show a few years. It draws about 5,000 people, so it's not a small thing. They're expecting a couple thousand for the show in Seattle. So it's the first time it's been in Seattle for almost 2 decades. So very, very interesting to see. Go register. Come see me. And since I've attended it, I've been to some of the breakout sessions. So I have an idea of what goes on. And I had to look. As I was preparing for Orlando, I began to look at who was presenting and what they were presenting. And it's interesting. I was checking some of my competitors, some of the other people who also manage money. And I came across one speaker who I've been in his sessions a couple times. I went to the conference in Las Vegas the last 4 or 5 years, and I was in his session a couple years. And I saw his presentation. I saw his graphs on how his clients were doing. He has a strategy, an approach. I wouldn't call it a model, but the idea is the same as a model. You know, his idea is to prevent you from going in the downturns and to keep you in the upturns. And when he presented in Las Vegas, he was trailing the market early in the year by a couple percent. So I was really surprised when I went on his website and checked and looked at his numbers. And his performance is absolutely what I would call spectacular. Spectacular. Now, something didn't completely click in my mind because I'd seen his actual client data early in the year, and now he's presenting something which was different. And so there's a little footnote, and that little footnote said, and I quote, "The performance-related information provided herein is not representative of performance in any client account, due to various factors such as when the client account was opened, the fee charged, and any client restrictions." Get this. It's not representative of performance in any client account. I can understand why there might be something because if somebody opened an account in the middle of this year, it'll be different. But I track all my clients. All my clients, I do a composite of all my client accounts. That's actual. And if they start, once they're a full quarter, we add that to the performance. If they drop out, if they transfer their account out, and I've had a couple of those happen, if they close their account because they pass away, if the account gets passed to relatives, all that information remains. It's 100% of every equity client. And my clients tend to be everything from conservative, moderate, and aggressive. All those are lumped together, and it's the actual performance. You know, there's no discounting that there's difference in fees, and there are differences in fees depending upon account size. There's nothing that is excluded, not any fee, not any cost, nothing. What you see is what has happened. I don't have a thing that says these performance reports are not representative of any client account. So anyway, what does that mean? You know what it means when you see something like that. The numbers they've put up there are not real. So why not just put up actual performance? You know, I've seen this any number of times. I've been in this business for 32 years. 32? Yeah, I have to think about it. I'm in my 33rd year. I'll be 30. Anyway, many, many times you see people that develop a mathematical model or a regular model or a strategy. They back test it, they check it out, they put up the numbers, and then when it gets to actually managing client money and executing the model or executing the strategy, it doesn't perform as it was back tested. That's just the way that goes. I've been around any number of those. I've had people approach me with models that wanted to actually to do their trades through me. You know, I had real hesitation. We ended up not doing it. The person, after a couple of years, suddenly disappeared completely. You know, no more clients. Everybody had realized the model didn't work. There's also something else, because after Mary Shapiro was replaced by Mary Jo White, as head of the SEC, went out and was smart enough to hire some quants, some computer knowledgeable people. And one of the areas they developed was an algorithm to evaluate performance numbers. And that has led to a number of firms being disciplined. The most famous, of course, is F12. F12 claimed great numbers. They claimed they didn't have losses during 2008, 2009. In fact, the numbers were bogus. Completely bogus. I had losses during that time. Most people did. Anyway, Mary Jo White instituted that, and so they can check numbers. So anyway, for what it's worth, that just got to me when I read that. I had to share it. I read that yesterday. So anyway, I'll be back. We're coming up to a commercial break. You want to stay with me? I do want to get to predictions for 2019. So don't go away. And you want to hear my guest today as well. I'll be right back after this break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm back again. We have a little bit to talk and wrap up this first segment, and then you're going to hear my interview with my guest today. Very interesting story to hear. And then I really am going to get to predictions for 2019. Sorry to keep you waiting and waiting. Hopefully you've been waiting and waiting. Hopefully you haven't turned off the radio. And if by now, if you've listened to me a few times, you know that I have a cold today. So, you know, I don't think it comes through the radio. But anyway, something significant this week is that Jack Bogle passed away. Jack Bogle was the founder of Vanguard Funds. He had an incredible impact on the markets. He was the founder of Vanguard, and he said he'd never known, nor did he ever know of anyone who had known a short-term trader who could beat the market. He did allow that there were money managers who did outperform the market. And for all the Vanguard funds that were index funds, Vanguard also had some money managers who were active fund managers. He recognized there was a difference. One of my favorite things about Jack Bogle was in 1994, he was supposed to keynote the Morningstar Conference in Chicago. And he had a heart problem, and instead of making the conference, he had a heart transplant in 1994. 1995, he came back to do the keynote address to the Morningstar Conference. And what he had to say was this: I was supposed to keynote this conference in 1994, but I had a change of heart. Anyway, Jack Bogle, pretty interesting guy. He was still in his 80s when I met him. Had a lot to say, a lot of information. But one thing he pointed out, it was something that had come from Peter Lynch and John Vander Heyden at Fidelity. They'd done a study between 1981 and 1991 showing what happened if you missed the best trading days in a year. That study's been repeated any number of times, and I looked it up. I found that Index Fund Advisors published a study, and it shows what happens if you miss, in 20 years, just 5 of the best trading days. What happens if you miss 10 of the best trading days, or 20, or 40? Stock market returns would be wonderful if they went up Stocks went up a quarter point every day, day after day, after day, after day, after day. Never down, just up a quarter point every day. It's not how it works. There are some days when you get a surge up, some days when you get a surge down too. But they looked at what happens if you have $100,000 invested on the 1st of January, 1998, and what is it worth on December 31st of 2007. And they're looking at putting it in a Standard & Poor's 500 index fund, strictly. There are 5,036 days during those 20 years of trading. Start with $100,000, and if it's in that index fund, $100,000 would have grown to $401,350. Your $100,000 would have earned $301,350. Now, if you missed just the best 5 days in those 20 years, instead of having $400,000, you would have had $266,250. Your gain would have been only $166,000, 45% less, just by missing 5 days. If you missed 10 days, that $100,000 would have doubled to $200,300, and your gain would have been $100,300. You would have missed 2/3 of the total gain by just missing half a day. That's 10 days out of 20 years. Think of that. 1 day every other year. And they're not consistent 1 day a year, but 10 best days, 98 to 2007. Think about that. That's through the dot-com, all that period of time when the market was essentially down and up and down. If you missed the best 20 days, your $100,000 would have been $125,700. Your total gain on $100,000 would have been just $25,000. That's just by missing an average of 1 day per year. You would have given up 91% of all the potential gains. And if you missed the best 40 days, that's an average of 2 days per year. Your $100,000 would have sunk to $56,700. You would have had a loss of $43,400. You would have been down over 114%. So the idea was there's a reason to put your money in and stay in the market. And as we talk about where we're going in 2019, we're starting to see money managers, having had a bad 2018, starting to do what's called FOMO. It's the fear of missing out. We'll see. Now, on the converse side, if you miss the worst performing days, you also get an extraordinary return. But you have to figure out on today if it's going to be one of the worst trading days tomorrow. And then you have to sell today to miss tomorrow and be back in tomorrow to pick up the day afterwards. With just being in the market, you don't have to worry about it. You can ride the downs, but over the long term, the graph starts in the lower left hand of the corner and ends in the upper right hand. From the 1st of January 2000 to the 31st of December 1999, I said 2000. I meant January 1st, 1900 to 1999. The Dow went from 66 to 11,400. That's a significant change. It's worth riding through those. That all sounds really great. We're going to come back and talk about 2019. I promise we're going to do that. I keep saying we're going to do that. But first, I want to introduce my guest today because he's got a lot of things to talk about, and it's well worth listening. Scott Armstrong of Brent Haven. Welcome to the program, Scott.
Thanks, Mike. Good to be here.
So why don't we start with your background?
Sure, good. Let's see, I'm from Seattle, born and bred in the Pacific Northwest. I went to the University of Washington, graduated there with a really useful degree in international studies with a focus on China. Somehow parlayed that into a job as a tour guide or a tour director for Princess Cruises, kind of my first job out of school. Eventually realized that to climb the ranks, I probably needed to go back to college, so I went and got my MBA. As I told you the other day, I was probably the last guy accepted to NYU that year. But ended up going to New York, Stern School of Business at NYU, had a great experience there, got my MBA with a focus in international business and marketing. From NYU, I really wanted to get back to Asia and really apply my undergraduate in China studies. So I took an opportunity to do an exchange program at the end of my MBA that gave me time in Hong Kong to find a job. And I ended up getting a great job in brand management for Bausch & Lomb, working on Ray-Ban sunglasses. So my role was really managing the Ray-Ban brand and its image across Asia. Fantastic first role. Bausch eventually sent me down to Australia. A few years later, the company was sold to Luxottica, and it was that time that my wife and I took the opportunity to come back to Seattle. Went to work for Starbucks. Fantastic experience. Ran the merchandise department at Starbucks, so all the tchotchkes that Starbucks tries to sell you on the way to get your morning caffeine, that was my job.
Don't know if you saw the news today, but somebody came out and downgraded Starbucks because they're not selling enough of those.
Is that right?
Yeah.
Interesting. Yeah. The merch program is definitely not what it was 15 years ago when I was there. Yeah, it's it's all about beverage. It's a food and beverage company that was dabbling in merch, and I think the right strategy is probably to focus there. But really a great experience. As you can tell by my background, I've always been a specialty consumer products guy. That's what I love. I was that kid that liked to go shopping when I was 15. Like, I really enjoyed going to Nordstrom's and seeing how they merchandise product and which products they pick and how they price them. And so that's really just carried through my career. And eventually, through a mentor of mine, I realized that my trajectory and my career was not going where I wanted it to go in big business, and I was really more suited towards entrepreneurial ventures. I had a family at the time. I couldn't exactly go do a startup without any compensation. So I realized that the opportunity for me was to go buy a business. So I hired a local investment bank named Meridian Capital, and we went out looking to find the right company for me to buy. And after about a year-long search, I found this amazing company in Bellingham called Brenthaven. It's got a very loyal following in Bellingham. I think our brand awareness in Bellingham is like 99%. And then if you go beyond the Kitsap County, it's maybe 1%. But it's
Whatcom County, by the way.
Whatcom County. Sorry.
Yeah.
Sorry.
I got it.
Yeah. Anyways, so joined the company in 2005. Bought my partners out in 2007, and I've been the president and CEO ever since. Really interesting, kind of, like most companies, we've pivoted along the way. Our focus when I joined the company was selling laptop bags to corporations. Companies like Bank of America, they were buying laptop bags for the laptops they were deploying to their employees, and they needed to keep them protected. The other part of our business was selling to retailers like Best Buy and Apple. And about 2011, we realized those markets were not growing at the same rate. Yeah.
Before we get to that,
okay.
When did you move from Bellingham to Seattle?
So I never actually relocated to Bellingham. Funny enough, my wife and I wanted to stay in Seattle, so when I bought the company, I bought a sailboat, and I lived on that sailboat when I was up in Bellingham for 3 nights a week in Squalicum Harbor. So yeah, no. But the company has obviously relocated down here. I took it slow. There were about 25 people up in Bellingham, and over the years we had attrition, and just slowly we would move roles down to Seattle. And so today we actually don't have any employees there.
Okay.
Yeah.
Now we're going to come back and talk about the company, but we're coming to a commercial break, so don't go away. Now you want to hear about what the company does. I think it's really, really an impressive story and impressive what Scott has done. So don't go away. We'll be right back. And I promise, get to 2019 projections. Don't go away.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
Okay, I'm here with Scott Thompson of Brenthaven. We started to talk about Brenthaven, so why don't we go back to that and explain what Brenthaven does and the evolution of Brenthaven.
Absolutely. So Today, our mission is really the same as it was back in 2005, and that is to keep our customers connected and protected on the go. So connected to their digital mobile technology, right? That whole world that you now have in your phone, your iPad, your laptop. The difference today versus when I joined the company is that our primary focus now is on K-12 schools. So many people don't realize that about half of students in the United States today, when they start school in September, they receive either a Chromebook, a laptop, like a Surface, or an iPad from the school, and it's actually provided to them by the school. And the reason for this explosion of digital technology in schools is that it allows the teachers to handle a larger classroom, and it allows for students to learn at their own pace. It also has shown over many research studies that there's more engagement from students with having a device that they use throughout their year to do their work. And so with those deployments, you need a really protective case because students are probably the most difficult customers on the planet when it comes to protecting your mobile technology device. And that's where Brenthaven comes in. So we make highly protective cases that keep students protected on the go.
So what is the advantage of the case? You say it protects them, but so I have a Surface that I work with.
Yeah.
It does not have a case.
Yeah, if you drop that, you're in trouble.
Okay. So what are the?
Yeah,
sure. If I drop it, what happens?
Yeah. So the Brenthaven advantage is that first of all, we're not the cheapest case on the market. Okay, you're going to pay a little more for what we offer, but what we offer is
that's okay. I'm not the cheapest money manager either.
Exactly. We offer tremendous drop protection. So our cases, we rate them at 2, 4, 6 feet. So we actually have many cases that you can put onto a device and drop it from 6 feet, and the device comes out unscathed. The second thing that we offer that no one else in the industry offers is a lifetime guarantee. So we stand behind our products. Any defects in craftsmanship or construction, we replace the product at our cost. So that's really, when you think about our customer who tends to be a librarian who was asked to deploy 1,000 devices out to students, it's that peace of mind that we bring them that has allowed us to be successful in the marketplace.
So I want to come back to the original question again. I have the Surface. If I drop it, what's the probability that something's going to break?
Oh, on the Surface, very high. You're going to see a damaged screen. You're going to see damaged corners. Your flash memory these days is probably going to be fine, but it's not going to be a device that you're going to want to use.
Okay. And probably, what's the probability? 25, 50%, 75%?
It really depends on how it falls, but as you can imagine, things don't fall flat. They hit a corner, right? And it also depends on what height and what you hit. So if you hit carpet, you're going to have a different result than if you hit a cement floor in a classroom. But yeah, you're likely to see damage. And what we hear from from the market research we do and from our just anecdotal conversations with our customers, if you deploy a device out to your students without a case, without some kind of a protective cover, you're going to see damage rates somewhere in the 25 to 30% range. So even if you bought insurance for all the devices, you still, as a tech director, have to spend all that time sending those back, getting replacements. It becomes a real headache. With our cases, typically we see less than 1% damage.
That's pretty amazing.
Yeah, well, I like to think so. So yeah, really, we pivoted in 2011. It's not to say that we don't still support our corporate customers and our retail customers, but our main focus as a company is this K-12 market, and that's what's led to the tremendous growth that we've seen, and probably the reason I'm here.
So if I walked into a store, if I go to Amazon, or if I want to provide Surfaces or iPads or whatever to employees, where would I go to find your case?
Yeah, our products are available on Amazon, but you're going to pay almost full retail when you go to Amazon, as you'd expect. It's a retail store. So the majority of our business goes through our channel partners, companies like, we use distributors like Synex and Ingram, and then, big resellers like CDW, SHI, Troxel. Those are the companies that are selling our products in the marketplace.
And is the brand name Brenthaven?
It's Brenthaven, yeah, Brenthaven. I spell that all the time.
And so if someone went to your website, would they find a place to go buy a group of these?
They would, yes. And there's a button there that says click here for volume pricing, and that's where you can find out more about how to outfit a whole school with our cases.
Because most people are not going to go home and say to their child, where'd you get the case?
Yeah, right.
But there are people that are listening to the program today that could. think about what you're doing and what you're saying. I never thought about buying a case for my computer. I saw some cases, but I thought, it's just an added expense.
Yeah.
It's in many cases like buying fire insurance. You hope you never, ever need it.
Right.
But if you do,
Yeah.
So the case is like that.
Yeah.
And I don't have a case for my Surface.
Yeah.
And I probably will go out and buy a case. And I probably will log on to Brent Haven. And I probably will go out.
We'll catch a good friend deal, Mike. Yeah, going back to the kind of the evolution of our company, when we were marketing to consumers, that was really difficult for a small business. But now that we've focused on K-12, and we've got about 10,000 customers around the country, 10,000 is kind of the universe of tech directors. It's much easier to digest. They're more receptive to our marketing campaigns than I think we would have, the success we had in the consumer space. And now, as a result of our the size of our company, we're able to tap into the majority of the market out there and see the market opportunities. So it's been a great market for us. And I guess, my key learning, both from Starbucks and from this business, is always pick the right market. Find a high growth market, because it's a lot easier to have success there than a market that's declining.
And I'll add, it's always good to pick the quality product as well.
That too, yeah.
Okay. Thanks, Scott.
My pleasure. Thanks for having me.
Great to have. Great story. So now I want to get to projections, 2019. I am actually going to talk about it. It's going to be a very unusual year in a lot of what's going on, because most of the news is probably going to center on Washington, D.C. And yet Washington, D.C. is full of politicians, not full of business people. And what happens with politicians is very often only tangentially important to businesses. So last week I talked about 2019 coming up, and I talked about looking at where we were. When the market came down from September to December, what happened is we didn't see earnings falling off. Usually when you see a market going down, earnings are going to decline. We didn't see that. Usually when you see a market coming down, it could be predictive of a recession. We're not seeing that either. What we're seeing, as I mentioned last week, we've seen a lot of computer selling. And again, I would recommend, if you want to know more about that, you'll find that on YouTube. You can find it on our website. You can go back and listen to that. But essentially, what I had to say is, what we saw and what we see are computer algorithms reading news, reading tweets, and reacting. And they can read a 2-page or 3-page news release and act within less than a second, faster than a human being can actually read the news release. They have read it, and they have sold, or they have bought. And on my machine, I have stochastic charts, and I see the candlestick charts. You can actually see the computers kicking in and suddenly moving the Dow 100 points. Or 20 points, or 15 points, or whatever it might be. It's an immediate buy. If you see people buying, and it moves up more slowly. With computers, it's an abrupt change. So that's what's going on. That's what drove the computer down, or what drove the market down from September to January. So that's made it really difficult for a lot of money managers, because they've watched, staying with the course with their strategy. Suddenly they're underwater with a strategy that should have worked. And so now you have what I call FOMO, F-O-M-O, the fear of missing out. They know that the market is undervalued. They want to buy in, but they also see that the market has come down for not a lot of reason. So they're also fearful that it'll continue to go down. So they'll wade slowly into the water and push the prices up more slowly. Now, computers, if the computers kick in, the computers can change that entire game by pushing the markets up very fast. Anyway, for my clients, we know we've gone through the drop. We were up 20% in September. We're up, I think, around 1% at the end of December. Now I think as of the 15th of January, we were up about 9 or 10% again. Yeah, it's a crazy time in the market, but over the long term, it's a positive thing. Being in the market has been compared oftentimes to a chess game, making the right moves, knowing what to move, when to move, where to go. 2019, my prediction, it's going to be like a checkers. It's simplified, it's straightforward. You go to the end, you get the kings made, and you come hopping out and crush the opponent. It's pretty straightforward. Not at all the complexity of chess. That's where 2019 is. And so as I talk about 2019, remember, I'm talking about a checkers game and not a chess game. At the same time, what's going to be going on in Washington is going to fill the news waves and the media. So I'm going to come back and talk about that because we're coming to a commercial break. Once we come back to the commercial break, I'll talk about some more specifics about 2019. Stay with me during this time because we've got a lot to talk about. This program and last week's program kind of go together. So once again, I say go back and listen to that one as well. I'll be right back after the commercial break. Don't go away.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So again, back to my quote from Yogi Berra. Predictions are difficult, especially about the future. You know, nobody has an exact crystal ball, but in this case, we can really see what's going on. The House now is in the control of the Democrats, and we know a lot's going to happen this year. There's going to be the investigations, which generate a lot of news. The investigation of the Russian interference in our election, the scandals that have plagued the Trump administration with the secretaries and the administration people. We're going to see new legislation passed. A lot of young, new representatives in the House were elected on essentially a platform of we need health care. That's going to rear up and come about. I'm not sure that that's top priority. Top priority seems to be a focus on ethics, and I think we'll start to see things there. We're going to see some things come out about minimum wage and the wages because wages have been stagnant for a number of years. They've been picking up, by the way, and they'll continue to pick up. We're going to see some focus on infrastructure. We're going to see concern about drug prices and legislation coming out of that. We're going to see some things about immigration. And we're going to see some excitement in my industry, but I'll get to that too. All those things are going to dominate the news. And business, what's happening in business is going to be less impacted by that than the news channels are. When you talk about what's going on, we have a lot of politicians who are not experts in foreign policy, healthcare. They're not experts in building and construction. They're not experts in business. We elected them as being representatives. They're not experts in a lot of fields, but they're dealing with all these subjects, and they'll talk about these subjects, and they're going to make some waves in a number of areas. The news is going to be much more brutal this year than the actual operation of fact. Yeah, you know, we're going to see the news come out. Don't be bothered by the news. Look at what the facts are and what the numbers are. You know, the economy has changed. Think about this. The largest taxi company in the United States does not own a single taxi. The largest hotel chain in the country does not own a single hotel bed. It's Airbnb. Uber and Lyft are the two big taxi companies. The largest media company in the country, maybe in the world, has no content. It has, and called Facebook, of course. We've come to a sharing economy. We're going to continue to see that sharing economy continue to grow and continue to reshape industries. Richard Foster of Yale, and I've been talking about this for the last 8 or 10 years, has said that the average life of companies in the Standard & Poor's 500 in 1920 was 70 years. The average life of a company in the Standard & Poor's today is 15 years. There was just a recent study done by InnoSight where they're saying that 50% of the companies in the Standard & Poor's face creative destruction. That means 50% of the companies will either be kicked out of the Standard & Poor's 500 or will be gone from the surface of the earth within the next 10 years. Think about that. Next 14 years. I'm sorry. I said 10. Think about how things are changing. You know, a couple weeks ago, I talked about what's happening in energy. If you look at energy, worldwide energy is a $7 trillion per year business. If you add up all media, the radios, the TVs, the magazines, all of that is a $1 trillion industry. And yet what we're seeing today with renewables, with fracking, we're seeing a very big change go on. And that's just the beginning of what's happening. It's going to continue to change and destroy companies. Those changes are going on. You know, I think it was significant that Jack Bogle passed away this week. He was the father of the index fund. We're going to see some changes in index funds because when 50% of the companies in an index fund turn over in a period of 14 years, that's going to impact those index funds. Instead of being reflective of what's going on in the markets, we're going to see something completely change. And what they will miss as well are those emerging companies which come from out of nowhere. Think about this. Microsoft went from 0 to $1 billion. It took them 14 years to go there. eBay and Facebook took 7 years to go from 0 to 1 billion. Zynga took 4 years to go from 0 to 1 billion. John Deere Company was selling 5,000 tractors a year. Zynga with Farmville was selling 5,000 tractors a day. I mean, who even remembers what Farmville was? That was one of those electronic games or electronic social network things that so many people were involved in. Today it's gone. Zynga is almost gone. It had its heyday, and then it's gone. Think about the cell phone you carry in your pocket. Remember the Palm? The Palm came out. The personal, digital, the PDF. You know, you had a stylus that you scribbled on the Palm to send messages with. I remember that. Then came the Palm Trio. And then came BlackBerry. BlackBerry had a phone that actually had a keyboard. You could send your email on the BlackBerry. So the Palm began its decline. Then came the iPhone, and BlackBerry's decline began. Today, Palm doesn't exist. Palm came with the Palm Pre, and as a loyal Palm, since I had it in the beginning, I had a Palm Pre. I was probably one of the only 7 customers that ever bought a Palm Pre. Actually, there were more than that, but, you know, the Palm Pre had nothing. The Android has come out. We're seeing creative destruction. That's going to continue during 2019. While we're going to see the economy continue to grow, we're going to see a lot of companies slowly disappear, and maybe not so slowly over a period of time. The idea for 2019 and 2020 and 2021 is to be ahead of the curve and not behind the curve. For 11 years now, I've been talking about the supercycle. That's the mile-high view of where we are. The supercycle, a study done by Standard Chartered Bank of the UK, said there were certain periods of time in our history when the worldwide GDP growth was higher than normal. The first from 1870 to 1913, driven primarily by the industrialization of the U.S. The second from 1945 to 1970, driven by the rebuilding of Europe, the decolonization. From 2009, they said there's a new supercycle that began that's driven by the emerging nations. Think about it. The forecast is by 2030, 93% of the world's middle class will live in emerging nations. 93%. We're seeing drops in poverty. It's almost predictable that poverty is on its way into a complete decline. We're seeing all those things. That's the overall drop. We have a market that's going to continue on. In 2019, who knows when it's going to take its bounce up. But we can see business has been very good in 2018. Business should be very good in 2019. It's a time to be in the market, not out of the market, but in the market at the right place at the right time. Anyway, my predictions about 2019, pretty short, pretty sweet. It's a game of checkers, not a game of chess. I'll be back next week to talk more about individual industries, individual things that are going on. Join me then, and we'll be talking about the answer about money. Till then, have a great week and weekend.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by